The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Money chasing money becomes the win-win strategy of our time. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Let's take a look at the S&P 500 fighting its way back into the green, now higher by about 0.1%. Really quiet overall when you take a look at what's going on in the S&P 500, in the NASDAQ 100, and what's going on in the bond market, which is pretty much nothing, of course. Warring words when it comes to what the U.S. is saying, to what Iran is saying. You can see that it's adding up to a whole lot of nothing when it comes to this equity market. A little bit more movement, though, when it comes to what's going on in oil. Brent down about 5%. We are now below $95 a barrel, Romaine.
Absolutely here, but Katie, whether the market is up or whether it's down, the pattern over the last few weeks seems to be the same, the momentum factor. That is how most investors are making money these days, as a pure factor play measured by Bloomberg momentum, outperforming on the week, the month, and the year. And an MSCI Global Momentum Gauge has beaten the All-Country World Index by 17 percentage points since March, on track for its strongest two-month outperformance on record. Ben Snyder and his team of strategists over at Goldman Sachs say within long portfolios, hedge funds carry a 90th percentile tilt to momentum right now. But if you think it's just the blind chasing the blind, Snyder says think again. He's not only raised his S&P price target, but also his EPS forecast to $340 for 2026. That's 24% year-over-year growth. And he's not alone. Veteran market strategist Ed Yardeni dismissing concern that U.S. stocks are in a bubble, arguing that the rally is driven by, quote, fabulous earnings momentum rather than speculation. He sees the S&P reaching 8250 by year end and doubts we'll even get another meaningful sell-off. Of course, some of this is dependent on the macro backdrop, a backdrop that has been less earnings supportive rather than earnings being more macro resilient, but a lot still hinges on that inflation picture and an off-ramp with the war in Iran.
The fundamentals have been phenomenal for earnings. We've seen earnings not only continue to go up, but go up at a faster pace. And that's what's driving the market up.
Let's talk a little bit more about the macro backdrop and specifically what's going on with oil, because you take a look at prices, even though we've been moving down when it comes to prices on Brent, we're still well above where we were before the war started. But it's a different picture when you take a look at the volatility of Brent. We have a 6-month chart behind me. You can see the volatility absolutely skyrocketed at the start of March here, but take a look at where we stand near the end of May. We're pretty much back to those pre-war levels. We know that, for the past several months, it's felt like it's oil that is driving the price action overall. Pick your asset class, but as this volatility comes down, it's an interesting question whether or not we're going to see oil reassert itself in the driver's seat or whether or not we're going to pay more attention to those more micro fundamentals.
It'll be interesting to see what the market focuses on, Katie, with Brent crude now down below 95 and WTI below 90. We kick you off to the close here on this Wednesday afternoon with Jeffrey Rosenberg, portfolio manager of the iShares Systematic Alternatives Active ETF over at BlackRock. All right, Jeffrey, the big question on everyone's mind is this inflation surge that we've seen as of late because of energy prices, whether that's something that the market is discounting, and more importantly, whether it's something the market should be discounting.
Well, what has happened is interesting. It's changed real yields more than it's changed inflation and break-evens. Obviously, the oil increase is inflationary, and we've seen that rise. But if you look at the decomposition of interest rate increases, it's really about changing the perspective on the path for Fed policy rates. And that tends to track the real interest rates more. And so that's really what the implication in the short run has been all about. We came into the year pricing 2 cuts. Now we're pricing 1 hike. So the shift in terms of the oil prices and the impact on the war for monetary policy has really been to take away this kind of normalization trajectory that we had started the year on.
But it raises a lot of questions as to why, at least the equity market is sort of looking past this. The idea that you still have a near record rally for most of the indices here on this day, despite some of those concerns lingering out there. And I know it's a narrow rally. And you don't necessarily see the same sort of song and dance coming out of the bond market. And I am curious as to whether they're singing different tunes right now.
Well, I would say that the bond market, and especially interest rates are really much more about the earlier conversation, monetary policy, the outlook for the Fed, inflation, and obviously the changes there. The equity market, and as your earlier segment just talked about in terms of concentration around earnings momentum, this is about AI momentum. And it is about the macro story that is permeating everywhere. It's a micro story in individual companies, but it is now the macro story for the macro economy as well. And it's powering suddenly or unexpectedly strong economic growth, because we're seeing it less from the consumer side, although that's getting a benefit from the wealth effect from financial conditions. But you're seeing it on the equipment and on the investment side coming through here. So AI is everywhere, and in that sense, you're seeing kind of a consistency between the bond market and the equity markets.
Interesting, and I want to talk about how that all folds into that ETF that Romain mentioned that you manage. The ticker there is IALT. And of course, when you take a look at your universe, it's equity, it's fixed income, it's commodities, it's currencies, the list goes on, liquid alternatives. And, you think about those different narratives, you do see, actually elements that fixed income and equity are still responding altogether to that AI theme. But it feels like there's been a lot of different cross currents. There's been a lot of different catalysts in terms of what drum the fixed income market is drumming, I don't know what metaphor.
Drumming, beating, spiking the football.
Walking. Anyway,
yeah.
It feels like, for fixed income, specifically treasuries, it's been more about the macro. It's been more about AI, classically, when you take a look at just equities. How do you fit this all together into a portfolio that is multi-asset in nature? So
IALT, IALT we call it, is really a solution to some of these big macro trends that we're talking about. In the equity markets, it's a little bit of too much of a good thing can be a bad thing. And while we're getting great index performance, those indices are becoming more and more narrow, right? So you think about things like your momentum comment, you think about the top 10 companies, you think about the incredible rally that we've seen in semis over the past couple of months. These are powering aggregate increases, but it's also creating a lot of concentration and challenging the concept of diversification. So when we think about IALT and where it fits within the portfolio, it's about providing another form of diversification. Equity markets are more concentrated. And when we talk about that macro story of inflation and the oil impact, we saw in March the loss of typical bond diversification to equities. Equities and bonds both went down on the surprise unexpected inflation. So IALT in the liquid alternatives, it's an alternative strategy, and it delivers diversification because the strategies that it pursues are market neutral. So we're taking out market direction and giving portfolios a differentiated source of alpha as a source of diversification.
Well, let's talk about the last 3 months, because we are approaching that 3-month anniversary of when the war actually broke out. How active have you been in managing this portfolio, in shifting your allocations, especially as you do see some of those correlations break down, as you mentioned, but then maybe come back a little bit?
Yeah, well, so it's really important to understand what IALT represents for the ETF universe. Most of what you see in terms of investment opportunities are plays on markets or access. Mostly what you're getting in that sense is beta access. And so when you're managing a fund that's primarily beta, your question is relevant. Like, how are you moving your exposures? What's your stock exposure? What's your bond exposure? In this strategy, it's much less about beta and much more about alpha. And what does alpha mean? It means balancing long positions with short positions at a very highly differentiated and diversified way. So when it comes to those big shifts that you're seeing typical beta managers have to navigate, we kind of take that off the table. We're not trying to navigate around the big stock versus bond. Rather, what we're trying to do is take out the directionality through long-short market-neutral investing. And so what this looks like is a lot of very small positions across the equity landscape, across the macro landscape, where we're both long and short, similar securities, different, similar enough to take out the market exposure, different enough to capture the alpha. And by doing that, we didn't have to navigate big shifts over the 3 months on the beta side because we really don't have that beta exposure to begin with.
All right, Jeff, great stuff. Great to have you here on The Close.
Thanks.
Jeffrey Rosenberg, portfolio manager of the iShares Systematic Alternatives Active ETF over at BlackRock. And our conversation about inflation continues with the big PCE report scheduled for tomorrow. We're going to catch up with former Boston Fed President Eric Rosengren in just a little bit.
And then we hone in on the consumer and what we're seeing in the buy now, pay later space. Cynthia Chen, she is CEO and founder of BNPL company Kikoff, gives us her read on consumer health and how it's helping or hurting businesses.
And from fintech to plain old tech, we're going to get a read on the software space by someone who invests directly in early stage enterprise software and AI company. Cheng, managing partner over at Microsoft's M12. She'll be joining us in just a bit as well. Stick with us. This is The Close on Bloomberg.
Well, gold falling for a second day on concerns that continued conflict in the Middle East will prolong inflation and keep borrowing costs elevated. But our next guest says that if and when the Strait of Hormuz does reopen and oil prices decline to maybe $80 a barrel, that gold could quickly cross the $5,000 threshold and eventually retest the 5,500 level. Aakash Doshi, he is the global head of gold strategy over at State Street Investment Management. He joins us now. So gold has been a really interesting one this year. I mean, you take a look at the year-to-date chart, we're only slightly higher than where we started the year with a whole lot of volatility in between it. So talk us through the current reaction function as you see it, what that interaction with oil looks like in a little bit more detail.
Sure. So, Katie, it's a tale of two halves. The first 2 months of this year, we saw gold very volatile, but rallying upwards. We saw record seasonal inflows for gold-backed ETFs in the U.S.-listed market. But then since the conflict in Iran started, a lot of the macro tailwinds that were buttressing a higher gold price regime reversed. So just prior to the war, we were expecting 2 to 3 Fed cuts this year. Now, if you look today, the STIR market is pricing in the 75% probability the next Fed move is a hike before the end of this year. You look at real and nominal interest rates across the belly of the U.S. Treasury curve. They've all risen rapidly on the back of that because of the higher oil price and potential inflation impulse. And then lastly, I would say, is the dollar trend. January, February, you had a strong dollar downtrend continuing on the 2025 weakness. Since the war started, the dollar's up 1.5%. That's not so large. It's a moderate return for the dollar, but at one point it was up 3% in March, and I think it's just the reversal of the downtrend in the U.S. dollar that's hurting gold through denomination effects. Yet you're seeing Chinese investors step in, you're seeing strong physical demand, and central banks continue to accumulate gold.
That's what I've been wondering. I mean, it's amazing to see the central bank buying. We've also seen, companies such as Tether come out, basically emerging as a new central bank in terms of accumulating gold. And then you mentioned the ETF buying, which, for a large part of this year has been very, very strong. And I wonder, how disconnected gold has come from some of its more traditional narratives, that this is a safe haven asset, et cetera, given just, the flow of funds here.
Yeah, so the oil price shock is very unique because it directly impacts the Fed channel. And if the Fed is on hold, but its next move is going to be a cut, gold can really benefit. Look, in 2025, the Fed was on hold for 9 months. Gold rallied 43%. If the Fed is going to have a hawkish turn and the next move is a hike, that's a little bit of a risk for gold because it increases the opportunity cost of holding a non-interest-bearing asset. What I will say is that this conflict in Iran and the war actually probably increases some of the structural bullish tailwinds for gold over the medium term. And what do I mean by that, Katie? That's geopolitical fragmentation that's likely to increase, not decrease, because of the conflict. The second point that I would make is wider debt and deficits. That CBO, the Congressional Budget Office, prior to the war in February in its last report, estimated the U.S. interest service cost would be over $1 trillion with a T in 2026. That's before yields backed up. That's before war spending. You also have emerging economies spending a lot on energy subsidies. This is going to add to the medium-term bullish case for gold in my opinion.
I am curious, though, too, particularly with regards to some of the central banks outside the U.S. holding gold with the idea of the de-dollarization story and obviously the fiscal issues here in the United States, but some of those countries are having their own issues, and wasn't part of the drop that we saw in the price of gold with some of those countries having to sell because of the conflict in Iran?
Sure. So you could look at Turkey as a prime example. They have been one of the largest buyers of gold over the last decade, certainly over the last half decade, and they sold significant volumes in the month of March to defend the lira. What people often forget is they also sold treasury holdings as well. So gold was effectively working as a reserve asset during this period of stress. Now, Russia also sold in March, but collectively, the official sector were large buyers, over 240 tons in the first quarter. That was up seasonally year on year and points to still, in our view, a very strong trend of buying that's likely to continue in 2026.
I am curious, if you are buying into the bull case, the prices will get back up well above 5,000, maybe even to 6,000 and beyond. Is a straight gold purchase, is that really the play, or do you maybe focus more on the gold mining stocks? I mean, what sort of provides the best potential for upside?
Well, gold is the commodity underlying.
Yeah.
So there you're getting that historically low correlation to stocks and bonds. You're getting the diversification benefit. You're getting a global liquid hard asset that's fungible, that has sources of demand abroad as well as domestically in the U.S. Look, gold mining stocks can be a great play. Last year in 2025, they certainly were. They also took quite a hit over the last couple of months as well. There, you're worried about company management, cash flows. It's a different asset class. You're going to have a much higher beta to the equity market overall. When I think of gold as a strategic allocation, I'm looking for something that's counter-cyclical or even non-cyclical. And that's what gold has proven historically in your portfolio.
All right, Aakash, great stuff. Great to have you here on the program. Aakash Doshi, Global Head of Gold Strategy at State Street Investment Management. As we continue to count you down to the closing bells and count you down to earnings from Salesforce. When we come back, a conversation about the state of the software sector with one of the main analysts that covers the space. That's coming up next here on The Close, right here on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. And let's start off today with Dollar General. Deutsche Bank downgrading the retailer to hold, cutting the price target to a near street low of $110. The analyst citing an increasingly challenged customer base, saying the K-shaped economic gap continues to widen, which limits upside to Dollar General's comp sales. Dollar General set to report results next week on June 2nd. And in fact, the shares, which are down about 30% since that last earnings report, getting a modest bid here on this Wednesday. Next up, FedEx, JP Morgan upgrading to overweight. The price target goes to a near street high, 460. The analyst bullish on FedEx's plans to spin off its freight business next week, writing the move will create structural improvements at FedEx's legacy business. Those shares on a 6-day run to a record high. And finally, Zscaler. Take a look at this. Evercore ISI cutting to inline, lowering the price target to 155 following the cybersecurity company's latest quarterly results. The analyst says slowing net new customers and sales changes create overhang for the shares. And well, that might be the understatement of the day, those shares having their worst one-day drop on record. Those are some of our top calls, and we stay in the software space, keeping an eye on Salesforce, set to report after the bell, along with several other names in the software industry. Michael Turrin is Managing Director and Software Equity Research Analyst over at Wells Fargo Securities. And Michael, everyone is keeping an eye on what Benioff has done with regards to Agentforce. There's been a lot of reporting by Bloomberg as to some of the fits and starts and rolling that out. And I know you've done your own legwork with regards to what's going on behind the scenes. What do you expect tonight?
Yeah, I mean, it's effectively a hold the line quarter for Salesforce. We think they have a tough needle to thread initially. While we think Salesforce will ultimately prove successful with Agentforce, we have concerns around the timeline they're committing to with investors. The company is already calling for a second half reacceleration of revenue and 11% CAGR through fiscal 30 for a business that's organically growing around 7% currently. So it's a bit of a tough initial bar to frame, and embeds a lot more optimism around Agentforce monetization than there's current evidence around. We think the product has started to meaningfully improve, but we've talked about this a bit, I think, in the past, Romain. Software business models, some of them have to evolve from seat-based to more consumption-oriented, and I think that's a part of the transition Salesforce is working through right now.
I mean, so the idea here, I mean, at least what we've seen with regards to the sell-off in a lot of these names is the idea that these AI agents replace that sort of a seat-based licensing model. Why don't you have enough confidence that Salesforce, given its size and more importantly, given its ability to pivot in the past, can make this pivot or maybe not make this pivot as quickly as you think?
Yeah, well, part of it is enterprise seasonality, right? These deals tend to be multi-year in length. A lot of the purchasing activity and renewal activity happens later in the year. So we're in Q1, which is a sub-seasonal period. We need to kind of build back to where there's just more customer engagement to be had. And then number two, there's a bit of a dance in terms of proving the value to get to the consumption revenue picking up. I think this is where right now software investors seem more comfortable in infrastructure or cybersecurity, where the business models are more aligned with something like consumption. With Salesforce, I think customers will want to see the value of Agentforce, and then from a multi-year perspective, you could see the run back up in revenue. But we think that's more of a 2027 than 2026 event.
And Michael, I mean, looking at your own rating on the company, you hold an equal weight rating when it comes to Salesforce, a rating that you've held since late 2023. You mentioned that when it comes to Agentforce, that, you know, with the proper timeline, that this is something that you're confident in. But I mean, is there anything that you would hear from the company tonight, that you could hear from the company tonight, that would make you rethink that? Or, you know, what sort of timeline are you operating on?
Yeah, I mean, it's a good question. I think the things that we're watching for are the disclosures they're providing around the data cloud and Agentforce specifically. Those businesses have continued to grow, but Agentforce is around 900 million, 800 million of ARR currently for a business that's 40 billion in revenue. It's just not enough to move the top line to the degree that the company is already communicating. I would point out that Microsoft is just starting to see more meaningful Copilot contribution. It's just in the last couple of quarters, we've heard Microsoft start to talk about 15 million, 20 million, next quarter more than 25 million paid seats. So some of these things are starting to happen with agentic and application software, but I think it's just going to take a bit more time, and that's where we wish Salesforce were doing a better job of keeping expectations in check and kind of allowing the model to build towards these things, not putting the reacceleration commentary and targets out so quickly.
And Michael, we have less than a minute here, but you know, sort of, you hear people say, when you think about the big decline that Salesforce has seen year to date, is that the network effects are very strong, that their clients are extremely entrenched when you think about their platform. And I wonder, you know, how much water that theory holds with you.
We published a survey today where 50% of CIOs mentioned the preference to use existing software vendors for deploying AI. We think that's much stronger than the market is currently reflecting. For those with the opportunity to take a multi-year perspective, we think this ultimately proves better for the incumbent software platforms, you know, those that are more entrenched like a Salesforce is, than the market's reflecting. So it's more a time scale than a technology issue at this point.
All right, Michael, great to get a preview with you. That is Michael Turrin of Wells Fargo Securities. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on this equity market, also keeping an eye on the economic data that we're set to get in the days ahead, starting with PCE tomorrow.
Yeah, this is going to be an interesting one. I mean, obviously, we had that hot reading in March. This is for the April report. Everyone's focused on the inflation. You know one thing I'm focused on?
Tell me.
I actually want to see the spending numbers.
Yes.
Because that's kind of been the surprise. Like with all the earnings we got out of all the retailers so far and apparel makers, it was kind of surprising to see just how well consumer spending held up. And there were some cracks, but nothing really where you would just say, oh my gosh, you know, we're falling off a cliff here. So I do wonder both what that nominal number as well as that real adjusted number when you adjust for inflation actually looked like.
And that really has been the story of the consumer over the past several years, just this resiliency, even in the face of, you know, very high cost of living and affordability crisis that, you know, the American consumer continues to spend. Let's keep this conversation going with Eric Rosengren. He is former Boston Federal Reserve President. Eric, it's great to have you with us. I do want to talk a little bit about spending, because you take a look at what our colleagues over at Bloomberg Economics are expecting here, and a potential silver lining could be that if we do see softening consumption in some of these discretionary categories, you combine that with negative real wage growth and a tepid labor market, that, you know, maybe the inflation that we're seeing start to come through, maybe some of those softening figures could have a dampening effect. And I wonder, when you take stock of these different cross currents in this economy, what you're expecting.
Well, let me start on the inflation side. The chart that you just showed expects that core and total PCE inflation is going to go up by 1 to 2 tenths probably when we get the report tomorrow. And that's on top of the fact that inflation has been gradually rising for some time. So it's not just coming from the war, it's coming from a variety of different areas. The war has certainly made it much worse with the oil shock. So I'm expecting we're going to continue to see inflation that year over year by the end of this year is still going to be at 3%. But as you've highlighted, the consumer still has been reasonably resilient. I would say consumption is weaker than you might expect given kind of the AI boom, the fact that the stock market is up, the fact that the unemployment rate is low. But nonetheless, I would say that given the size of the oil shock, it's been positive news that consumption has been this resilient.
And I wonder where you think this leaves the Federal Reserve, because, you know, we're counting down to the June meeting. It will be Kevin Warsh's first meeting as chair of the central bank. And we heard from Fed Governor Chris Waller last week, really making waves that, you know, you take stock of things right now. He sees even odds for either a hike or a cut as the next Fed move, with the expectation they might be on hold for a little bit. You know, is that a calculus that you agree with when you think about where inflation is and where it's shaping up to be?
I do agree with that. I think that the easing bias that's in the current FOMC statement probably should be taken out. Now, that's a challenge for the new chair because the administration has been hopeful that we would be lowering rates, and taking out that bias is going to be a signal that there is a reasonable chance that we should be raising rates rather than lowering interest rates because of the inflation problem. So I think it will be a very interesting meeting. Governor Waller is not the only member of the FOMC who's been discussing their concerns about inflation. There were 3 dissents at the last meeting saying that the inflation bias the easing bias should be removed. So I think they're going to have a spirited discussion about how long this inflation is going to persist and what that means for monetary policy.
One thing that I've been curious about, Eric, I mean, there's been a lot of talk about the K-shaped economy, but you actually see that kind of play out in some of the data. We saw that with the last PCE report, where you saw, of course, higher energy prices, higher prices for, you know, memory chips and things like that. But you saw a lot of household supplies, household goods actually show a decline to a certain extent. And my general understanding, at least based on the economist estimates, is that we'll probably see that trend have continued for April. How do you take that into account when you are trying to decide whether rates should be tighter or looser, given that potential divergence?
So there are always different elements of the inflation index that are going up and down. And so there tends to be a focus on the overall trend that we've been seeing. And obviously, food and energy prices have been impacted. But the core PCE still has been trending up for quite some time. So when you take the entire bundle together, it is a problem for the Fed. The Fed has a target of 2% inflation. It looks like we're going to be above 3% on a core measure through this year. That's a pretty big miss, and it comes after 5 years of missing on the inflation target. So I think the concern of many members of the FOMC is going to be that wage setting and also financial pricing is starting to reflect a concern about higher prices. So we've seen Treasury rates go up, we've seen mortgage rates go up, we've seen Treasury swap rates go up. Those are all consistent with increased concerns about where inflation's going.
I am curious, too, if the inflation issue that's taking place right now, and I understand it's real, but there's also been some discussions just about inflation expectations kind of becoming unanchored, given some of the issues that have risen with the Fed and obviously with this transition from a Jay Powell era to a Kevin Warsh era. What can the Fed do with regards to non-monetary policy, so basically with regards to communication, to maybe get inflation expectations a little bit more anchored to where the Fed would like them to be?
The most important element is that people are convinced that the Fed is still very focused on hitting their 2% inflation target. And so that communication and some concerns about whether the Fed is going to continue to be as independent as it has been in the past, that's going to take actions rather than words, actually, probably to fully convince investors and people that are setting their wages that inflation will be under control. So some of that is just going to take some time to see how the committee under Kevin Warsh actually takes into account the inflation movement that we've been seeing over the last 6 to 9 months. And I do think that communication is important, but it's kind of consistent communication, that the Fed is not completely abandoning the desire to make sure that we have a low inflation rate that doesn't affect people's decision making.
All right, really appreciate you taking the time for us, Eric. Eric Rosengren there, former Boston Fed president, to look ahead to that PCE data that we get tomorrow morning with Bloomberg Economics forecasting that we will get about 0.43% on month to month, which would push the year-over-year rate back up to 3.8%. Now, coming up, we're going to talk about, well, our stock of the hour, and it is a big one. It's a stock of the day. Dycom having its best day since 2020. It's kind of an old economy, kind of digs ditches and puts cables down below, but it's got a new life here, particularly with regards to the data center build out. We're going to catch up with the CEO when we come back after the break. This is Bloomberg. All right, time now for our stock of the hour, and it's got to be Dycom. The share's on fire, up more than 30% to a record high after the communications infrastructure company reported first quarter contract revenues and a second quarter outlook that topped Wall Street consensus. Joining us right now is the CEO of Dycom, Daniel Peyovich. Dan, great to have you here on the program. I'm absolutely fascinated by your company, and forgive me for starting this in a way that might seem a little glib, but these sort of, old companies that have kind of found a place in this newfangled world. And I think about what you do. It is very basic to a certain extent. I understand it's a little more complicated, but you're basically laying cables. You're connecting the world to a certain extent. And I am curious about the new business that you've been getting with regards to sort of laying down what then becomes the conduit into a lot of these data centers and out.
That's exactly right. First, thank you, Romaine and Katie, for having me back. It's great to be here again. And you're right, fantastic results on a fantastic quarter. We grew 56% year over year. 25% of that was organic. And just like you said, Romaine, what we do ultimately is we bring the skilled workforce, over 20,000 men and women now working across America, to ultimately connect everything starting in the data center, bringing the power within the data center itself. Now we just added a company with a new acquisition, National Technology Integrators. They do the structured cabling in the data center, goes to the racks. From the racks, we're taking it all the way out, what we call inside the fence work, then long haul, middle mile. Ultimately, we get it all the way to the homes and businesses across America. So we really are an end-to-end digital infrastructure solution today. And your point is exactly right. We're the folks that are out there doing the work, out in the elements, putting it in, rain, sleet, sun, shine.
Well, as you mentioned, you announced also an acquisition today of NTI. I'm also taking a look at some of your stats, and you've recently added in a big way to your workforce, adding 700 workers in the quarter. Talk to us about what the future looks like here, whether we should be expecting you to be continuing to adding headcount, continuing to be pursuing deals here.
Yeah, and thank you, Katie. As I talked about when I was here a couple of quarters ago, I'm a huge advocate of the skilled workforce. And again, we're a significant employer. What we like to do is really bring people in and upskill them into our trades, into really coming into Dycom, not just for a job, but hopefully for an entire career. And we provide that entire suite of training. So what you see, that headcount add 730 this quarter, that brings us up to, I believe, over 1,000 in the last couple of quarters. And we're going to continue to do that because the demand has never been stronger across our space, whether that's what our customers are looking for fiber connection to the home, fiber to the businesses, connecting the data centers themselves, or of course, inside the data center now. That demand is so significant that we need to continue to do that organically. And then also, to your point, we're going to continue with M&A and looking responsibly. Again, we've got a good strategy. You've seen that strategy over the last couple of quarters. We're going to continue that as we look to add other quality businesses to the Dycom family.
I am curious. You've kind of called this in the past this kind of a generational deployment right now of digital infrastructure. There is also a federal program for broadband access, broadband build out, the BEAD program.
Right.
That is supposed to start contributing to your bottom line, and if so, how material would that be?
Yeah, and what's exciting is, we raised our outlook for the year significantly, over $500 million. That does not include any contribution from BEAD. We really look to BEAD, that Broadband Equity Access and Deployment Act that you talked about. That's only incremental and an upside for us for this year. if you think about that work, Romaine, it's just going to take a little bit longer to come through the pipeline in a big way. So if we think about calendar 2027, calendar 2028, those are the big years for the spend. And we think that that addressable market is $17 billion. That's addressable for Dycom alone.
All right, Dan, we'll really appreciate you joining us on what I'm sure is a busy day. That is Daniel Peyovich. He is CEO over at Dycom. Dycom shares at a record high right now, currently higher by about 24%. Coming up next, we're just about 15 minutes away from those closing bells. We're going to take you there with Tony Roth. He is CIO over at Wilmington Trust and M&T Bank. That conversation coming up next. This is The Close on Bloomberg.
Just about 10 minutes until we get to the closing bells. Romaine Bostick alongside Katie Greifeld. The market's kind of been in the red for a good portion of the day, but it looks like the S&P and NASDAQ trying to squeak out a modest gain.
Yeah, pretty quiet when you take a look at the first three lines on that board. It's going to be interesting to see if we get more direction in the after-hour session when we get to some of those software earnings, including Salesforce. Oil is very interesting today, lower by about 4.5%, even though we heard from President Trump earlier today saying that he's not satisfied with the negotiations with Iran. And there's a lot of question marks over the Strait of Hormuz, whether or not we're going to see safe passages resume, and who's basically going to be looking after that.
It's kind of interesting, though. You aren't seeing like those big market swings that we used to see when, we would get some commentary about, oh, we're going to, bomb Iran or do, the opposite or whatever. I mean, you saw the market softer, the equity market softer in the early session, but then you saw a lot of those dip buyers come back in and say, look, if I'm going to get a discount on, Micron or whatever, Qualcomm, whatever it is, why not?
Yeah, that's the thing. It feels like for the equity market, the story is relatively simple. Earnings have been fantastic. When you extend out to maybe some of the other asset classes, fixed income, for example, it's a little bit harder when you factor in the inflation picture. But at least for right now, pretty quiet across most fronts.
Yeah, as Ed Yardeni called it, fabulous earnings momentum, FEMO, as he calls it here. Let's bring in our next guest, Tony Roth, the CIO over at Wilmington Trust and M&T Bank. And Tony, I do want to start here with kind of the resiliency that we've seen in this market over the last 8-9 weeks or so, in the face of course, all of the issues that are still pending out there with regards to the situation in the Middle East, and more importantly, the ripple effects with regards to the economic situation here on inflation and consumer spending. Are you surprised by what the markets have been doing?
I am, and I'm not, Romaine, and it's great to be here this afternoon. You all remember the cartoon that you watched when you were a kid of the mouse chasing the cheese, and then every time the mouse got close to the cheese, the cheese would be attached to a string and they'd pull it away a little bit.
Just cruel.
Exactly, even for the mouse. So that's the metaphor of this market. And the cheese, of course, is anything that would cause the Strait of Hormuz to open up. And so we have a fundamental backdrop where forward earnings right now are only about 21.5 times. Slicing the salami pretty thinly there, but that's an attractive level given this momentum of earnings growth that we have in this market. We could be significantly higher on the indices and particularly on the tech stocks if we were able to get the cheese. And so right now we have this very delicate balance between, on the one hand, starting to believe that the ceasefire is held and we're going to eventually get that agreement and we're going to sort of explode to the upside. And then on the other hand, believing that this may be the status quo for some time. And if it is, we could see much higher oil prices later in the summer.
Well, I am curious, though. I understand the earnings picture and why there is optimism around it. I guess what sometimes I get a little confused about is this would be a bit of a different story if stocks weren't already at record highs. I don't mean just the S&P, but when you talk about stocks in the S&P that are up 300-400% on a year-to-date basis so far, there's always this idea, anytime you're near a record, there's always that risk that if anything goes wrong, everybody's going to look for the door here. Am I supposed to think that this time is going to be different?
Well, when you think about the record, Romaine, you're thinking about the nominal value of the stock market. But when you look at the value of the stock market on an earnings basis in an environment where the overall rate of earnings growth has been 20% in the first earnings period of the year, 20% for the overall market, over 30 to 35% for the tech sector, that is a phenomenal earnings rate. And so the market may be up, let's call it 8 to 10% this year, but the earnings are up far more. And the momentum of that earnings growth is very high. So when you put those together, even though the nominal numbers, when you look at the indices every night on the TV, if you will, I'm an old guy, look high. They're not really that very high relative to the earnings that the markets are delivering today.
And it's interesting. I mean, you think about the equity market, and as we were chatting about, I mean, you think about that fundamental story, that earnings are fantastic right now. How long can that power this rally? When you think about some of the cross currents coming from, obviously, the geopolitics of it all, but also what that means for the Federal Reserve, which it looks like for the foreseeable future is on hold. And then the next move from there, it's anyone's guess.
Yeah, Katie. So first of all, I think that we need to have an outlook on where the price of oil is going to go over the rest of the summer. And if we end up with an oil price, let's call it $100, $110 or lower, then I think that there's still good momentum in the market. And whether that's accomplished through an agreement or whether that's accomplished through a lack of agreement with the management of the narrative from the administration really doesn't matter. Just a question of where that price of oil is and the impact it has on inflation and so forth in the market. So that's sort of the picture as it relates to the market. And the second part of your question again was,
of course, what this means for the Federal Reserve and
for the Federal Reserve. So sorry about that. So for the Federal Reserve, very similar set of factors. And one of the phenomenon that's really important to keep in mind with this economy is the divergence that we have between the stock market and the economy. We're seeing tremendous gains in profitability of the stock market due to a increasingly large portion of the market that's focused in technology, which is an increasingly large contribution of overall earnings. But then on the other hand, we have the consumer, the K-shaped economy, and consumers aren't doing very well on the lower end. And so we probably will end up with a growth rate this year from a GDP standpoint of between maybe 1%, get plus or minus a 0.25%, depending on when the straits open up. And that is not the kind of demand environment that creates inflation. And so with this new Fed chair coming in, our expectation is that we are going to see rate cuts this year because we just don't have enough demand in this economy, with or without the straits open, to create the kind of demand side inflation that causes the Fed to want to hesitate on rate cuts.
And Tony, just about 45 seconds here. How much conviction do you have behind that we are going to see rate cuts this year? I hear what you're saying about demand, but then you consider the various supply shocks working their way through the global economy.
Well, Katie, if you subscribe to the basic premise that the administration needs to get a deal one way or the other on Iran because of the midterm elections, which I know is contrary to what the president said. He said he didn't care about the midterms. So if that's your view, then don't listen to what I'm about to say. But if you believe that the president and the administration indeed does care about the midterms, and it has a big impact, in fact, on what he can accomplish and the fiscal pocketbook over the next 2 years, then I think you have to operate on the presumption that we're going to get a deal, and that deal is going to allow the inflation picture to temporize over the rest of the year, and ultimately that's going to inure the benefit of stocks and monetary policy.
All right, Tony, really great to catch up with you. Tony Roth, CIO at Wilmington Trust and M&T Bank, counting us down to the closing bells as we get headlines out of the Fed's Lisa Cook saying that she thinks rates should stay where they are for now. The idea that she wants to continue to see that fight against inflation. Our global simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell. It's a global simulcast. Tim Stenovic joins us from the radio booth. Christina Ruffini in today for Carol Masser. Welcome to our audiences across all of our Bloomberg platforms, television and radio, and our partnership with YouTube. On a mixed day on Wall Street, Tim, a lot of eyes right now on the inflation picture, but also a lot of eyes still on that tech trade.
I'm on the edge of my seat right now, looking at the S&P 500. Because it's up barely 2/100ths of 1% right now.
Oh my God!
And if it closes in the green, guys,
I think he's just flexing.
We're going to see a fifth day in a row of gains for the S&P 500.
And you're excited about this?
I'm so excited about this.
That's great.
I get excited about small things in life.
I hear you.
It's very different things get us excited. I got excited that we had an analyst come in here and agree with me on the fact that the geopolitical reality of the Strait of Hormuz is not quite reflected in all this green we're seeing on your screen right now in the market. That's not really being priced in a reality check of whether the strait's going to open or not. I don't think we're seeing that in the market.
Christina, reality is just a construct.
All right, I'm doing my
is time.
Welcome to the simulcast, Christina.
I will say, Christina, though, I was sort of turning over that question when you take a look at what's going on with oil today, down 4.5%. We're right about $95 a barrel on Brent, even though, you take a look at the words coming from the president, it doesn't seem like negotiations are necessarily in a great place right now.
Yeah, absolutely. Here, a lot of headlines crossing the terminal right now. We were just talking about those comments from Lisa Cook saying that she would raise rates if disinflation doesn't reappear, in a red headline crossing the terminal right now. This involving Perella Weinberg saying that it's cutting almost 10% of its workforce, including about a dozen partners. That's according to a person familiar with the situation. Meanwhile, back to the public equity markets, and it looks like, Tim, you're going to get your record high here. It takes a while for these numbers to settle, but right now the S&P perched at 75.20 and change, up about 1 point, and that is, what did you say, a 200th of a percent? Or
Yeah.
I don't know, I forgot what you said.
200.
Either way, it was a record high yesterday, so if it's in the green today, that's another record high. The Dow adding about 183 points, or 0.4%. The NASDAQ up about 19 points, or less than 0.1% on the day. The Russell 2000 looks like it's going to sit this one out, down a fraction of a percentage point.
Yeah, looking at the S&P 500, just peeling back one of the layers there, we actually did see fewer stocks move higher than move lower today. 236 stocks in the green today, 263, Katie, in the red.
A quick look at the circle, a real tug of war going on at the sector level here. You can see consumer discretionary was your gainer when it comes to the percentage gains, higher by about 1.9%. Consumer staples also higher. What dragged us lower, or tried to, energy down 1.5%. Financials, too, not having a great day either. Salesforce earnings crossing the wire right now. Let's get right to it here. The company says that for its fiscal first quarter, revenue came in at about $11.13 billion, about on the nose of what the street was looking for at about 11. Adjusted EPS, $3.88. That is a beat. The street was looking for $3.13. Here right now is your forecast. The company says that for the full year, I'll take the full year, adjusted EPS, $14.06 to $14.12 a share. That guidance is above its previous guidance of $13.11 to $13.19. The company says that it still sees its adjusted operating margin at the same level of about 34.3% here, and it sees its revenue growth re-accelerating in the second half of fiscal 2027, which is interesting commentary. We were talking with Michael Turrin, guys over at Wells Fargo Securities, and he said that his read on Agent Force is that this is less of a 2026 story and more about deeper into 2027.
It'll be interesting to hear from Mark Benioff commentary on the call. I mean, this is a company that's been just beat up from those 2024 highs, down more than 50%. Mark Benioff, the chair, CEO, he said that agentic AI is the biggest growth opportunity for our customers, for Salesforce. We're number one in agentic CRM. Agentforce now powers every Customer 360 application. It helps tens of thousands of businesses across every industry transform into agentic enterprises. But Katie, as the stock reaction has shown over the last few months, the company really does have to convince the market that, these companies are not going to give up buying certain seats or offload some of these tasks to some of these AI companies that could be worth $1 trillion in the public market soon.
Yeah, absolutely. That's really the primary concern of Wall Street, is that you have this competition coming from the likes of Anthropic, from OpenAI, sort of an existential question hanging over Salesforce shares. And it's been interesting that, it's mightily underperformed the bounce back that we've seen in software stocks overall and the NASDAQ 100 overall. And you can see that, we're trying to decide what to do after hours right here. Salesforce currently in the green, but certainly the knee-jerk reaction was to send it lower.
Another interesting headline, and this involves the remaining performance obligations for the most recent quarter. That did actually miss. It's $67.9 billion. The street was looking for $68.9. The company, though, does say that for the current quarter, the fiscal second quarter, it sees remaining performance obligations up about 14% from that number. So that could put some downward downward pressure on the stock because, of course, that is a big metric about where things are going forward. The company, guys, also did say that with regards to agent force, it said 50% of the agent force and Data 360 bookings, which is effectively the future of this company, came from existing customers.
Okay. Salesforce shares down about 0.4% right now. We are still awaiting Synopsys, Snowflake, Marvell Tech, HP Inc. as well, coming in the next few minutes. I want to reiterate some of these numbers as we do look at the equity market reaction of Salesforce reporting results just now. As the company sees second quarter revenue coming in $11.27 billion to $11.35 billion. The estimate was for $11.36, so just shy of that outlook there. First quarter revenue did come in above expectations. First quarter adjusted operating margin came in above expectations at 34.8%. The company sees adjusted second quarter EPS 325 to 327. The estimate was for 325. Salesforce in the after hours down about 1.4%.
Yeah, and it's going to be interesting, again, like you said, Tim, to hear from Mark Benioff himself and also to hear, what the sell side wants to hear from him when it comes to Salesforce. Certainly, there's the idea out there that you think about Salesforce's clients, about its platform. This is a deeply entrenched sort of offering that they have. But still, you think about future growth here. That's the concern.
Let's get right to Snowflake. Their earnings are out. But I first want to start with a headline from the Wall Street Journal saying that Amazon has struck a $6 billion deal with Snowflake for agentic chips. That is the headline, and that's a big part of the reason why the shares are up more than 10% here in the after hours trade. As for the numbers, in the first quarter, it looks like the company did beat modestly. $1.39 billion on the revenue side. The street was looking for $1.33 billion. And as far as the EPS, 39 cents a share. The street was looking for 32 cents. Here's your guidance. The company says expect for the full year adjusted operating margin of 13.5%. That's an increase of about 1 percentage point over its previous guidance, and says that product revenue for the full year, $5.84 billion. It had previously seen $5.66 billion, so a slight nudge higher on that.
Wow, shares just surging in the after hours, up 23%. I want to draw everyone's attention over to Synopsys. Shares bouncing around a little bit. The company sees third quarter adjusted EPS above estimates, 363 to 369. The estimate was for 362. The company sees third quarter revenue coming in above estimates as well, $2.4 to $2.45 billion. Shares bouncing around in the after hours. They were lower, now they're higher by about 0.7%, Katie.
Let's also take a quick check on Marvell here as well, getting those earnings after hours. And when it comes to the first quarter adjusted EPS, that actually matched estimates, bang in line at 80 cents for the first quarter. Their first quarter net revenue coming in a touch above expectations, $2.42 billion. The estimate had been for $2.41 billion. In terms of the look ahead, the second quarter adjusted EPS expectation, it's a pretty wide range. They see 88 cents to 98 cents. The estimate had been for 90 cents. They also see second quarter EPS not adjusted between 32 to 42 cents. You take a look at the reaction in shares right now, popping after hours, higher by about 3% at the moment.
I do just want to go back to Snowflake. They now are confirming that cooperation pact, at least as they're terming it here, with Elliott Management now. Remember, they had been that's Synopsys, my apologies, Synopsys, entering into that cooperation pact with Elliott Management with regards to the activist stake and some of the changes that they were looking for. That includes adding Jesse Cohn to the board. I do want to go back quickly to Snowflake, though, up 26% right now here on the back of that Wall Street Journal story saying that Snowflake will buy about $6 billion in these AWS chips over the next 5 years. Remember, Snowflake is basically an AWS native company, started in 2012 and basically was on the AWS platform since 2014.
And Amazon shares, not doing much, but on that news too, just up about 0.3%. That is going to do it for our cross-platform coverage of the market close. Don't worry, though. We're going to be back tomorrow, same time, same place.
I hope so. And stick with us. Our coverage continues here on Bloomberg Television. Deeper dive into the software space, particularly after those earnings that we just got from Salesforce. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A record-setting day on Wall Street, though, well, man, you'll take it. The S&P 500 up 1 point on the day, but you know what? A record high is a record high. 5 straight days of gains. But look at the second line on your screen. That is the MSCI Emerging Markets Index, and that largely reflects the phenomenal rally going on in really the developed markets in Asia, primarily Korea, and the big chip stocks over there like SK Hynix, which continue to rally. A bit of a pullback in bank stocks today after some commentary by JP Morgan and some of the other big banks, and not much action today in the yield space, so that could change with that PCE report tomorrow morning.
Let's take a look at some of the big after-hours movers, because we did get some earnings at the top of the hour. We start with Marvell reporting their first quarter adjusted EPS that matched estimates when it comes to their second quarter outlook. The range that they gave for second quarter adjusted EPS, the midpoint of that fell ahead of the estimate. You can see shares higher by about 3%. Snowflake now higher by 30% after hours. That, of course, follows the news that AWS has signed up Snowflake as its latest chips customer, certainly giving a big boost to Snowflake after hours. And then Salesforce is where we end, giving a lukewarm outlook. This was a company that has been down in the dumps in terms of the share performance year to date. A lot of concerns about the competition from some of those big AI companies, and you can see that continues in the wake of their latest earnings.
Absolutely. Salesforce, the main maker of customer management software. Snowflake, we should point out, obviously a big data software company, and the divergence that we're seeing in those stocks today may tell a bigger story about what's been going on in the software space. Gil Luria joins us right now, head of technology research over at DA Davidson. And Gil, let's start off with Salesforce. Overall, I mean, we're still talking about a company growing, maybe a little bit slower than what it was in the past. But everybody really wants to know what exactly this pivot to agentic AI and this 360 model, and whether Mark Benioff can pull it off. What did we learn, or what did you learn out of this report just now?
Well, the two stories, Salesforce and Snowflake, couldn't be more different. And to your point, they do illustrate what's happening in software right now. So Salesforce expectations were very low. They're trading at 10 times cash flow. Nobody expected anything. And yet, especially in terms of their guidance for the next quarter, that looks like to be a disappointment. And that means that transition that you're talking about for moving into more AI-centric and having that drive and acceleration in the business, that's just not happening yet. The company has talked about the fact that they expect to start accelerating in the back half of the year and going forward. They gave 5-year guidance for double-digit growth, and yet right now it looks like they're going to grow more like 6, 7, 8% on an organic basis. Next quarter, that's going to require quite a bit of acceleration in the second half. So that transition to AI is taking a lot longer, to being driven by AI is taking a lot longer based on these results.
It seemed like one of the theories with regards to how Salesforce could sort of thread this needle on this AI disruption was the idea that it would kind of become, like the Switzerland of AI, if you will. It would kind of offer everything under one umbrella. Do you see that as a potentially viable strategy? And more importantly, would it even be a unique strategy, given it seems like some other companies have the same idea?
It is a viable strategy, and there are some companies that are in a position to do that. Microsoft, Salesforce, ServiceNow, these kinds of companies that are very much embedded and entrenched with their customers can come to those customers and say, look, you can have humans and agents work in one place that is where we are. To your point, a Switzerland, the place where agents and humans meet to interact and get tasks done. That is a viable strategy for a company that is so entrenched with its customers, and its customers rely on it so much to operate. That vision makes sense. It just hasn't shown up in results. And let's not forget, Salesforce got ahead of its skis a couple of years ago, talking about how Agentforce is going to drive an acceleration, and we've now had 2 years of significant deceleration. So until they're able to deliver on the acceleration, the strategy is just that. It's a strategy, it's a vision. It's not translating to results quite yet.
And I do want to quickly bring in HP. They're reporting results right now. They see third quarter adjusted EPS 61 cents to 71 cents. The estimate had been for 64 cents. The full year look here, adjusted EPS between $2.90 to $3.10. They had seen $2.90 to $3.20, so narrowing that range a little bit. HP shares higher by about 12% or so after hours. But Gil, when it comes to Salesforce, there was an interesting note from Bank of America last week reinstating their coverage of the company. They have an underweight rating there. They expect structurally lower growth, and their phrasing was that they see Salesforce basically transforming from this historically high growth platform into more of a mature cash generator. And you mentioned, that it's a deeply entrenched platform, but you think about the future and the ability to add new customers. I wonder whether or not you agree with that logic.
Yeah, I would just say that it's fully reflected in the stock. Again, at 10 times cash flow, it's very well understood that Salesforce's days of driving significant growth are behind it. It is right now more in the mode of being able to possibly be a good cash generator, return cash to shareholders. They've significantly increased their buyback. That's the mode Salesforce is in. But again, that's why they're trading at 10 times cash flow. To believe they're going to go down below that is to believe that at some point the business declines and shrinks and is a melting ice cube. I don't think we're quite there yet. I think for now we're just talking about slower growth. And as long as there's a good return of cash to shareholders, maybe some good M&A, good accretive M&A, the company can continue to do better than it's doing right now.
And Gil, before we let you go, I do want to talk a little bit more about Snowflake, because now that after hours rally, we're talking about gains of more than 30%. Again, the big headline was that in addition to the earnings that they reported, that AWS has signed up Snowflake as its latest chips customer. We're talking about a $6 billion deal. I mean, talk to us a little bit about how you're viewing that and whether or not this huge reaction that we're seeing after hours sort of matches the news itself.
Snowflake is winning. Their expectations were very high. They're trading at 40 times cash flow, and they easily exceeded those. And in this deal with Amazon, they're entrenching themselves in the AI ecosystem. So they're making themselves more valuable in that ecosystem. What's happened this year is initially the year started with all software companies going down. And what's happened in the last few weeks is we're seeing a separation between winners and losers. Snowflake, Datadog, smaller companies like JFrog, they're winning. And then companies that are left behind, like Salesforce, unfortunately, are going to continue to linger down here. Big change, big dispersion of outcomes, big diversion in outcomes, and a discrepancy in outcomes. And that's what's happening. Snowflake is winning. Their role in AI is getting bigger, and the deal with Amazon illustrates that.
Well, that dynamic certainly playing out right now. Snowflake shares higher by about 29%. Salesforce shares lower by 1.5%. Gil, great to break down the action with you. That is Gil Luria. He is head of technology research over at D.A. Davidson. And coming up, we're going to stick with the software space. Ray Wang, he is Constellation Research CEO. He joins us next. This is The Close on Bloomberg. Checking in on shares of Salesforce, now down about 3% after hours. Earlier this year, the firm becoming somewhat of a symbol of the SaaS apocalypse. That is that stock meltdown hitting software as a service providers. But our next guest notes that AI is not killing software. Let's bring him in now. His name is Ray Wang. He is the CEO of Constellation Research. Ray, great to have you with us. And okay, maybe it's not killing software, but certainly, I mean, picking up on the conversation we were just having with Gil Luria, you are seeing this real dichotomy start to form between the winners and the losers here in the software space.
You know, you're right. Gil is talking about a tale of two software types of companies. Not all SaaS companies are created equal, but AI isn't killing software. The moats are data, distribution, relationships, and experience. If you've got systems of record, transactional data, it's not like you're going away. But then the flip side is you're getting seat compression. And seat compression is real. Are we going to switch from seats to tasks, seats to utilization, seats to tokens? And will you be able to make up that volume? And that's the question investors are asking. And so are you going to prevail over UX or interface aggregators? Those companies are going to go away. But the companies that actually have, they have the staying power is going to be the companies that have data. I mean, take SAP, for example. Everyone thought ERP was going to go away by now. ERP is still growing 20, 30% at SAP. And so you see examples like this popping up everywhere. And so the question is, are we getting the hyper growth? Probably not. On the Snowflake side, that's very different. This is infrastructure. And what we're talking about is infrastructure software, which is really different because they're in the back end. And what they're doing is basically delivering durable revenue and massive growth. And they're tied really closely with growth.
Right. No, it's a fair distinction there. But I do want to bring this conversation directly to Salesforce, because you think about data, distribution, relationships, experience. You know, you could make the case that a company like Salesforce has that in spades. And yet this is one of the companies that has been the most punished by the market in this sector.
I would say they're unfairly punished in this case. You know, the move from per user to per task, they're basically adjusting. The main thing that they're doing is adjusting pricing from user-based to utilization. When Salesforce pioneered the SaaS pricing model developed by per seat, that changed the whole market. They're doing the same thing right now. They've got to turn it from within. And what they're doing at this point, if you think an Agentforce ARR, it's about 800 million. It's 2% of their 41.5 billion in annual revenue. But, you know, that's going to be the growth engine. So the question is, will they be able to optimize and maximize on tax? Will customers be able to operate at 10x scale versus what they're able to do with just human labor, now using digital labor and agents? And I think that's what the street's waiting to see. But it hasn't taken off in the way that the street's expectations, which have been very, very high. At 10% growth and free cash flow about 14 billion, that's a great set of numbers, but not for what we're doing in the age of AI at the moment.
Well, that's what I'm curious. I mean, how are we going to judge the progress, and particularly given, and we should point out, we didn't read this earlier, but you know, the company basically said it's going to kind of narrow the way that it reports. So basically, just kind of two big segments. So a little bit less visibility, if you will, at least in terms of what they actually report on paper. Maybe you get that in the commentary. But I am curious, Ray, you know, as an analyst, if you're trying to figure out exactly whether they are making good on some of these lofty promises, what are you looking at?
I think the main thing we're looking at is whether the largest customers are moving on to Agentforce, and then how quickly are they moving to Agentforce? What parts of the business are they using it for? What are they doing to replace? Are customers getting a return? One metric that they've been talking about is tokens. I think that's a good metric for the short term. I think the longer term metric is going to be looking at, you know, what type of those agents are doing and what the deployment against those tasks are. It's the number of tasks that are going to be that model. We're going from user-based pricing to utilization. That's going to be the big piece, and watching how that utilization curve moves up. Is it going to be a 20% gain? Is that a 50% gain? Is that a 100% gain on utilization of tasks? That's where we're going to see the inflection point.
I am curious about on the utilization side, and more importantly on the other side, meaning the companies that are doing that utilization, which of course is money out the door for them. And we've heard a couple of companies, and this is more anecdotal at this point, basically say they've kind of been shocked at how high some of the costs have been with regards to utilization rates. Does it get to a point with regards to at least where the pricing is right now, where we think that pricing is going to go, that some of these companies might be a little bit more restrained in rolling out these products, certainly to every employee, the way that they have so far?
Well, it's actually the interfaces between machine to machines to agent that's going to be where the growth models are going to be. It's not going to be about every employee. It's about end-to-end tasks. So, for example, campaign to lead, order to cash, incident to resolution, procure to pay. Each one of these mega processes normally would have had 3, 5, 7 users. Now it's a question of what the agents are doing with each other. That's going to be the part where we're going to be looking at 12 to 18 months from now. The other piece that's important to think about is each one of these tasks as we move to digital labor is going to change how companies are going to buy. They're actually going to buy by outcome. So traditionally, if you had a contact center agent that you're paying $7 in Mexico, $9 in Columbus, Ohio, you're now going to go from $7 to $3 to $2 to $1 with digital labor and digital agents. That's one pricing model that's very popular. The other pricing model that's actually happening is, for example, let's take supply chain software. If you had a $50 million business process outsourcing engagement, it might now come down to $10 million. And so you're going to see that shift from 50 to 40 to 30 to 10, but it's not going to be $1 million of software. It's going to look like the Palantir model, where we're actually selling services and outcomes and software all at once and basically just buying the outcome.
Ray, always a pleasure. Ray Wang there, CEO over at Constellation Research. When we come back, we continue this conversation. We talk about the legacy companies that might survive this shift in software. And more importantly, if you're a new company starting up right now, what is that company going to look like in this new software future? We're going to catch up with Cheryl Cheng, managing partner at M12. Salesforce shares remain under pressure in the after-hours trade, a beat in the most recent quarter, but guidance going forward just a little bit light based on what the street was looking for. Our next guest has spent the last 15 plus years investing in early to growth stage software companies, and she says these legacy companies like Salesforce that do maybe survive the technology shifts have to embrace new technology to redefine how they serve customers. Of course, that's playing out in real time with some of these names like Salesforce. Let's bring in Cheryl Cheng. She's managing partner over at Microsoft's venture capital fund, M12. All right, Cheryl, I do kind of curious as to sort of what this transition looks like, because you also talk about this idea about how some of these legacy companies do sort of have a moat, but to a certain extent, that moat just kind of buys them time rather than sort of fending off the barbarians at the gate. What's going to happen?
Yes, absolutely. So I do think that the established companies absolutely have a moat right now in a couple of ways. One is the data that they have in working with their enterprise customers. The second is the trust that they have, the security that enterprises need to be able to operate their businesses. They absolutely trust the incumbents to safeguard their data and their processes.
Well,
however,
I'm sorry,
go ahead.
Keep going. I'm sorry.
No. But I do think that this is a call to evolve with AI, especially agentic workflows, that these incumbents do need to embrace this change if they want to continue to defend their turf.
I am curious, though, in the short term. I mean, I understand the trust factor, and I think it's probably safe to assume there are a lot of large customers that will stick with the Salesforces and some of these other big software companies. But that doesn't necessarily mean that these companies are going to have the revenue growth and, more importantly, the profit growth that investors have gotten used to in previous years. Should we expect to see a little bit more margin pressure, a little bit more of a slowdown in these business models?
I think the traditional business model is going to change. So traditional enterprise SaaS must evolve in the face of agentic AI if these businesses want to survive. It's to be determined whether that means rapid margin erosion or profit depletion as a result. If these companies can shift their business models as well as their technology architecture, they could still turn the ship and capture a lot of the upside that AI offers to all industries.
And Cheryl, we talk about disruption all the time, and currently, I mean, you take a look at what's going on in Salesforce shares, that fear of disruption is working through itself. But, to talk about trust a little bit more, that, that could be a factor in the advantage that incumbents have. Talk to us about what that means for the smaller companies, the startups, trying to break in here when it comes to agentic AI. How much of a lift is it, an uphill battle to try and establish that trust?
It is an uphill battle. If you are a small startup selling to a large enterprise, you need to be able to demonstrate that you can handle their data safely and that you have all of the safeguards for the edge cases of their business to be able to help them serve all of their customers at the level of service that they demand. So one of the things at M12, as Microsoft's early stage venture arm, we do invest in early stage startups, and we help them navigate through those gates to be able to sell to large enterprise. As Microsoft, we work with every single industry across a wide range of enterprise customers. And so from M12's perspective, we really try to help these startups get to that place. And what I really like to see with startups is companies that start with selling to small to medium-sized enterprise first. From there, that is a wedge that gets them to understand the workflows, the processes, the way that they need to handle enterprise data. And then we help them graduate to larger enterprise sales. And that is something that is the holy grail, but it does take time to get there, which is a very different motion than what you see a Salesforce or some of the larger enterprise SaaS companies have to deal with today, which is navigating a large established product into the agentic era.
Well, we were having a conversation with a guest yesterday that, when it comes to some of those large enterprises, the attitudes around AI, agentic AI, that the attitude is sort of shifting from FOMO, fear of missing out, to sort of a fear of messing up. This concern that, you don't want to see these AI agents run wild and run up costs. And, I wonder, in working with startups and working up to that holy grail of large enterprise customers, whether or not you're seeing that attitude shift at all.
There's definitely a fear of missing out. Enterprises can't afford to be left behind in this evolution towards AI. At the same time, there are guardrails. So what we're seeing is certain functions within the enterprise adopt AI with still a human in the loop. So rarely do you see agentic AI just run completely wild within an enterprise. There is still always a human that's checking that work. And over time, they're building those safeguards as well as those guardrails for AI to run autonomously. But for now, almost in every function, whether this is finance, procurement, supply chain, marketing, there is still a human in the loop. And I think that that is the proper way, more responsible way to bring AI into the fold in these enterprises.
I am curious, though, too, also just with regards to what we're seeing in the public markets with the software sell-off, at least prior to this last couple of weeks, we had a pretty significant sell-off. And obviously, you're seeing some names start to recover from that. But when you look at sort of the compression, the valuation compression that we're seeing in public markets, what does that mean for some of the companies in your portfolio that may have been looking for exits sometime soon out of privates into public? Does that change the calculus?
That's interesting, actually. I don't think so, because most of these companies still have pretty healthy balance sheets and could still buy with cash. But I also think that this contraction that we saw in the public markets with the large companies is more of a harbinger of like what will happen if you don't change. But I don't think any of these large enterprise software companies are sitting back and doing nothing. So I think that this contraction was kind of a wake-up call, more so than this will be their valuation and it'll continue to slide in perpetuity. I think that the leaders in these businesses are absolutely taking the actions to move towards an agentic future. From an M&A perspective, honestly, the businesses that we invest in are so early stage. You know, seed to Series B is where M12 typically invests. And when I invest, I definitely don't think about exit right away. We think about building enduring, long-standing businesses that can grow for a long time. So we are less focused, at least in the immediate, on what the exit multiples could look like, given where the buyer market is today.
Fair enough. And you've also had a bit of a focus primarily on healthcare, fintech. And I am curious with regards to when you look around at the various sectors, even the ones that maybe are outside your direct purview, and you look at not just AI adoption, but the folks that you think are doing AI right, why do you think healthcare and fintech have maybe been a little bit more far afield than some of the others?
By far afield, you mean adopting more slowly or
no, adopting,
doing things differently?
Adopting in a better way and a faster way than other sectors.
Well, fintech and healthcare, they've always been heavily regulated industries, and for good reason. And so as a result, as founders are thinking about building AI and fintech, or AI fintech and AI healthcare solutions, they have to take into consideration all the regulations that the industry operates in automatically. So there are a lot of things that just cannot be done quickly with AI the way that they're done in consumer, in healthcare and fintech. So the buyers of these software are absolutely thinking about the places where AI can accelerate workflows and innovation, knowing that there is regulatory constraint all the time in these industries. And I don't think that's going to change, even with AI.
All right, Cheryl, that's a good place to leave it. Always wonderful to catch up with you. That is
great to see you.
Cheryl Cheng. She is managing partner over at Microsoft's venture capital fund, M12. Meanwhile, let's take a look at some of the notable movers in the after hours. A lot of earnings names on the list here. We start with HP, higher by about 0.3%. Marvell now extending its gains higher by about 6.3%. That looks pedestrian compared to what we're seeing in Snowflake right now. Now higher 32% after hours. Of course, they did give a stronger than expected outlook, but they also signed a $6 billion multi-year agreement to use AWS and chips from Amazon as well. And Synopsys down about 2%. This is The Close on Bloomberg. The U.S. consumer under pressure. Bad weather, tariffs, and dwindling cattle herd pushing up grocery prices at an above-average pace. Now this as investors race for another inflation print with the Fed's preferred PCE measure due tomorrow morning. Let's discuss with Anna Wang. She is Bloomberg Economics chief U.S. economist. Anna, great to have you with us. So a lot of different cross currents here to try to take stock of. When you think about what we're going to get in terms of April figures tomorrow, what is the house view over at Bloomberg Economics?
Well, on the headline, we're going to see an increase from 3.3% to 3.8%. And on core, we're going to see an increase from 3.2 to 3.3%. So all of those are pretty ugly prints, but that's not the peak yet. And we're expecting that the peak to be reached in the next month, most likely, or at least before July. And we think that the headline will eventually peak above 4%, maybe around 4.1 or 4.2%. So I think the Fed basically, under the new chairman, Kevin Warsh, would not be able to cut rates anytime soon based on these ugly inflation prints.
Well, I am curious, though, is all of this primarily being driven by energy prices? Because, I mean, doesn't the Fed sometimes kind of discount that with the idea that, okay, they'll be, for lack of a better phrase, transitory?
Yeah, I mean, it's not all energy related. So, in fact, when you listen to the Fed officials talking recently, several of them pointed out that there are other shocks in the inflation reports lately that worries them, such as the shortage in global memory chips related to AI data center build out. And that is pushing the core PCE up by another 0.5 percentage point this year. And I personally think that that is a more persistent and worrisome inflation number.
All right, Anna Wang there over at Bloomberg Economics, a preview of that PCE data that we get tomorrow. Obviously, a closer look at the Fed's preferred gauge of inflation. But don't forget, those numbers also include personal income and personal spending numbers. And there's been a little bit of a signal flashing underneath the surface of the consumer economy. The idea that more Americans right now are using buy now, pay later, not just for those big purchases, but for a lot of everyday items, sort of just like buying takeout or, buying groceries and things like that. Our next guest is the CEO and founder of the consumer finance fintech platform Kikoff, which is dedicated to helping individuals achieve financial health through credit building. Cynthia Chen joins us right now to talk a little bit more about some of the trends that she's been seeing. And Cynthia, when I saw this, I was like, okay, on one hand, I was alarmed, but then on the other hand, I thought, is this a real sort of, warning signal about the state of the consumer economy? Or is this just kind of that generational shift where younger people just do things a lot differently than the other generations?
We definitely see some generational shift in the usage of buy now, pay later, as some of the younger generations, such as Gen Z and millennials, are a little worried about the revolving interest on credit cards. So they alternatively use buy now, pay later to finance not just large ticket items, but also small purchases, such as a food delivery order or groceries. Data shows that 40% of Gen Z consumers use buy now, pay later at least on a weekly basis.
I am curious, when buy now, pay later first became popular, one of the selling points was the idea that it did not have a direct impact on your credit score. We now know that FICO has started to roll in buy now, pay later metrics to reflect the borrowing in that space. So what happens to the credit scores when you're using buy now, pay later for relatively rudimentary type of purchases?
This is a great question because indeed 40% of buy now, pay later users have made a late payment in the past 12 months. So when buy now, pay later data gets reported to the credit bureaus and also gets incorporated into the credit score calculation, late payments of more than 30 days can indeed negatively impact a consumer's credit score. The major buy now, pay later players are just starting to furnish data to the credit bureaus, but it's still pretty early. So I would say the majority of buy now, pay later transactions are not being reported yet.
Well, I want to talk a little bit about the pay later aspect and whether or not you are seeing people increasingly miss payments as you start to see, a lot of consumers use it for more of these everyday items. When you think about groceries and gas, these everyday sort of bills, are you seeing an uptick on those missed or late payments?
About 43% of the buy now, pay later market is now for small ticket items, meaning items below $300. So yes, because the more creditworthy customers tend to use buy now, pay later for larger ticket items, and consumers who are trying to make ends meet to use buy now, pay later for groceries or food orders tend to have smaller ticket items. Then the small ticket item purchases are more likely to be delinquent just because their users tend to have less financial means.
And we're talking about generational divides here, generational behaviors. We've talked about Gen Z a little bit. I mean, are you seeing some of those older consumers? You think about boomers, you think about maybe some Gen Xers as well. What does their usage looks like? Are there any meaningful trends developing when it comes to some of the older segments of the population?
One interesting observation in this industry is that some of the older and more affluent consumers are also starting to use buy now, pay later more frequently. Regardless of a consumer's income or age, they all tend to prefer fixed payments and no revolving interest and or no late payment fees relative to credit cards.
Cynthia, final question here, and this is more about your own business and what you've built in a relatively short period of time, $1 billion valuation. And there's been a lot of talk about the disruption out there from artificial intelligence, and more importantly, how companies like yourselves are embracing that in order to sort of make sure that your company is ready for the future. Have you started to roll out internally or even externally to your customers any sort of AI tools that would aid in what you're doing?
Yes, we rolled out a suite of AI tools to our consumers. Last year, we introduced the AI debt negotiator to help Americans tackle the debt problem. As we know, the average American household has a debt amount of over $100,000, and many are struggling to pay. The AI debt negotiator will call your creditor or lender and try to negotiate debt relief for you. We also introduced what we call Fin, the credit coach. That is an AI credit coach that will teach consumers on how to improve their credit and how to budget better.
Cynthia, really appreciate you taking time for us. Cynthia Chen, she's the CEO and founder of the fintech firm Kikoff, which of course focuses on consumer finance and your credit score.
Well, let's take a look again at some of the big movers after hours, because there's a lot of them. I do want to talk a little bit about Salesforce, down about 2.3%. It was an interesting, really past few hours. You think about the conversation that we were having with Cynthia Chen. You think about the conversation we were having with Wang, talking about sort of the incumbency advantage here when it comes to SaaS. Basically, the trust that needs to be cultivated among these large enterprise customers that should benefit a Salesforce, but again, we haven't necessarily seen that bear fruit. Shares down about 2% again.
But it was kind of interesting, too, to get kind of that earnings report around the same time that we got Snowflake. And obviously, a big part of the move higher is partly on that Amazon deal. But it also gets to something, and I think it was Wang that brought this up, this idea of this kind of being, Snowflake being more of the backbone of this whole AI data build out here, and how that gives it a little bit more resiliency, certainly in the short and intermediate term, relative to a more front-facing company like a SaaS company like Salesforce.
Yeah, absolutely. It's going to be interesting to see how this stock opens at 9:30 tomorrow morning, as, of course, traders digest what we hear on the earnings call from the likes of Mark Benioff.
Yeah, and we're actually, and also I just want to point out Marvell, too. Of course, this is a semiconductor company, up about 8% here. And a headline now crossing the wire off of the conference call with the CEO, Matt Murphy, saying that they expect to get fiscal year 2027 sales of $11.5 billion. So that appears to be a guide slightly above what the street was looking for. Based on Bloomberg estimates, the street was kind of modeling for just under $11 billion. We should also point out this was a company that had less than $5 billion of sales just about 3 or 4 years ago. So some phenomenal growth over the last few years.
Yeah, absolutely. Of course, that data center demand really helping to boost their forecast when it comes to the second quarter guide, when it comes to the 2027 full year guide there as well. I do want to quickly shout out Snowflake as well. That gain now extending to 34%. They reported earnings, but it's that AWS $6 billion multi-year deal that seems to be the big catalyst.
All All right, we're going to set you up for what to watch over the next 24 hours, and that includes quite a few other earnings, including some consequential ones after the bell tomorrow. Stick with us. This is Bloomberg. Here's what markets are going to have their eyes on over the next 24 hours. We're going to get another read on the consumer. In fact, quite a few reads on the consumer with some earnings before the bell. Katie, from Dollar Tree, Burlington Stores, and Best Buy.
Yeah, looking forward to that, particularly when it comes to Dollar Tree. This is another stock that's been beaten up year to date. We'll see, of course, what the sales traffic looks like there. Then after market, the party continues. We do get more consumer names, more retail names in the form of Gap and American Eagle, but we also get Dell, MongoDB, NetApp, and Okta as well.
Yeah, and MongoDB could be interesting. Those shares rallying in the after-hours trade right now. They were up about 9% on the back of those earnings we got out of Snowflake. So kind of a brother from another mother there. So the idea that maybe this becomes a rising tide lifts all boats for them of those. But Dell, phenomenal rally. 442% year to date so far.
Well, before we get those numbers from Dell.
Do you have a Dell?
I don't think I do. Oh, I have a very old laptop, as you might imagine. But we do get that 8:30 a.m. U.S. PCE report, of course, certainly going to be consequential to this market.
We're going to get new home sales at 10 a.m. and some more Fed speak. We'll have all of that coverage right here on The Close as soon as it happens. For all your political coverage, stick around. Balance of Power is up next.